This is Brian. Happy to be with you guys again. I'll give you just kind of a quick overview of our business before we dive into the content here today. But for those of you that are not familiar with TaxConnex, we do focus very specifically in the sales and use tax world. So we're about a 100-person firm. Jeff and I are based just outside of Atlanta. We've got about 30, 40 people here, and then the rest of our team is spread throughout the country. But within sales and use tax, there's really two practice areas that we have here, and one of those Jeff heads up for us, and that's our consulting and advisory practice. And most of what we'll be talking about today kind of fits into exactly what Jeff does on a day-to-day basis. But it's helping companies understand where they have nexus, where they have taxable sales, specific to mergers and acquisitions, kind of looking at where they have sales tax exposure and risk and how to remediate that exposure. So those are very specific topics and project areas that we focus on. And then the second practice area is a compliance outsourcing service, where we essentially become an outsourced sales tax department for businesses. And a big portion of that is focused on the sales tax registrations, as well as the filings and the remittances to the jurisdictions on a regular basis. But, in terms of the agenda, we're really here to focus on M&A topics. And if you've been in this industry for more than a day or two, you've probably seen some type of issue related to either a merger or an acquisition. And when it comes to sales tax, it often pops up from a due diligence perspective. A lot of times we see companies that just don't have a great grasp on sales and use tax as they start to grow their business, and then they eventually look to exit that business. And surprisingly, there's a large sales tax exposure that they've got to deal with. We try to encourage those types of businesses to get out in front of that and hopefully deal with it before you reach an exit point, but it doesn't always work that way. We've represented companies on the buy side as well as on the sell side, so we'll have some stories to tell along the way from those two perspectives. But you can kind of see the agenda here, really talking about the nexus and taxability determination and estimating your exposure, and what are some of those then remediation options that might present themselves so that we can clear up any past sins from a sales tax perspective.
So today, wanted to really talk a little bit, and as Brian kind of gave you the overview, about sales and use tax as it relates to mergers and acquisitions. Most of the discussion today will probably be from the seller's perspective, things that you need to be prepared for, but just recognize that both parties have a significant vested interest in sales and use taxes when an acquisition or investor scenario starts to take place. The common storyline that we often hear, this is particularly true if we're brought in kind of after the fact. And when I say after the fact, we've got a client or a prospect that's come to us and said, hey, I am getting ready to sell my business. We've already had some due diligence performed by the acquiring entity. They've identified some situations or circumstances that aren't favorable to us from a sales tax risk perspective. And they're just looking for some guidance and some help. So the typical scenario might be that a company's going through the due diligence, the buyers identified and estimated maybe $2 million or more in sales tax risk and exposure. And what the buyer is going to do naturally is secure themselves from that risk, either through escrow or forcing some type of action or reduction in the purchase price. And the question becomes, as we operate businesses or we're operating within businesses that might be candidates for acquisition in the future, do we at least have knowledgeable facts around our sales tax requirements and our compliance footprint? So we'll talk a little bit about what that looks like and what it means here in the next several slides. But that's sort of the idea is we've got an opportunity to either sell the business entirely or maybe it's to take on a significant investor. And today we find that buyers and investors are much more sophisticated and much more in tune with sales tax risk and exposure. So it's coming up more and more often during due diligence. We like to start any discussion related to sales and use tax with just a revisit of nexus. Nexus is really the factor that has to exist before you should have any real dialogue or analysis around sales and use tax. And nexus is simply the term used to reference a connection. If you have a connection with the state, if you have some level of activity or presence within a state that affords that state to impose its taxing laws on you, then you're deemed to have nexus with that state. When we talk about nexus from a sales and use tax perspective, historically, and this is going back into the 1960s, the standard has been physical presence. There historically had to be some physical activity. Now, that doesn't have to be a permanent physical activity in the form of an office or even in the form of an employee based in the state. It could also have included things that were temporary in nature. Maybe it was inventory that passed through the state temporarily. Maybe it was agents or employees visiting the state periodically to solicit sales. Or it could have been someone in a third-party capacity performing services in the state. So there was a number of factors that would drive and contribute towards physical presence. The big change in this world of sales and use tax nexus occurred back in 2018, almost 5 years out from that now. And that was the Wayfair decision. We call it the Wayfair decision because South Dakota had legislated an economic nexus standard. No more did they want to rely solely on physical activity or physical presence in the state. They wanted to be able to reach out and touch those companies that were generating significant revenues or have material market availability to themselves within the state. So South Dakota said, if you have more than $100,000 in revenue during a 12-month period, or you have more than 200 transactions during that same period, we're going to deem you to have nexus for sales and use tax purposes. You're going to be required to comply with our sales and use tax laws. And ultimately, after this legislation passed, they asserted nexus against Wayfair, Wayfair being a very somewhat popular online retailer of home goods. They asserted nexus, they assessed them, sales taxes. Wayfair decided to challenge the constitutionality of that law. It went up through the South Dakota Supreme Court. Interestingly enough, the South Dakota Supreme Court ruled in favor of Wayfair. But the state took it to the U.S. Supreme Court. U.S. Supreme Court agreed to hear oral arguments in April of 2018. And in June of 2018, came back with their decision 5-4 in favor of South Dakota. In essence, blessing the concept of economic nexus for sales and use tax purposes. And as you might imagine, all of the states had their ears to the ground on this one. Some of the states, I think, were pretty heavily involved in the case in support of South Dakota. There were quite a few companies that were also involved, interestingly, on both sides of the fence. Some that wanted this economic nexus to pass, others that wanted not to see it go any further. So as this ruling came out in June of 2018, there were a whole list of states ready to introduce their own legislation along these same lines. And as it stands today, every state that has a state-level sales tax has instituted an economic nexus standard, meaning that the mere generation of revenue at a certain threshold will, in fact, establish nexus for sales and use tax purposes and require you to comply with that state's sales and use tax laws. Now, the flavor of all of this, and when we're talking about it across the entire country, the way to think about it is if you're exceeding $100,000 in any given state during the course of the year, you need to evaluate whether that's a trigger for nexus. 100,000 is the more common threshold that most of the states adopted. There are outliers. There are states like California, Texas, that have a $500,000 threshold, which is obviously more meaningful and more beneficial. There's a few states like Mississippi and Alabama that have a $250,000 threshold. New York, I think, has a $500,000 threshold, but also has a requirement that in addition to the 500,000, you have at least 100 transactions in the state during that year. So there's a little bit of variability out there. Not all of the states have adopted the transaction test or the transaction threshold, but those that have adopted it, other than that New York 100 transaction example, have adopted a 200 transaction threshold. I tend to encourage people, particularly as they start to evaluate this, if they're new to the economic nexus analysis, to really stay focused on the revenue side of the equation. Get through that analysis. That's where the real pain and the real risk is going to exist. And then as you get more and more confident, comfortable, and get a plan in place, you can start to address and decide whether or not to address those states where you've met the transaction threshold. Just a couple of other nuances that I'll mention before moving on to the next piece. Alaska does not have a state-level sales tax, nor does Delaware, New Hampshire, Montana, or Oregon. Alaska, however, is a little bit different in that there are cities in Alaska that have their own sales tax laws and administration. And interestingly, those cities in Alaska have formed a coalition and enacted their own economic nexus standard that reads similar to the other states. It just basically says if you have more than $100,000 in sales into the state of Alaska as a whole, then you automatically have nexus with each of those cities that are part of that coalition. There are some cities, I believe, that are still outliers that have not become part of that coalition, but a great deal or a great portion of the cities have. And then lastly, DC is really considered a state. DC has its own sales and use tax laws and administration, and it functions just like a state, so they too have an economic nexus standard. There's some other nuances across some of the other states, not really wanting to focus too much on that today, but if there are any questions about some other states and nexus and economic thresholds, we'd be happy to try to answer those today. So that's sort of the step one. And again, just to restate the obvious, do we have nexus in the state? And again, stepping back a bit, as we're considering the value of our business and the risks that exist within the business, taking that first step and evaluating nexus is a big deal. It's very helpful. It, at a minimum, gives you a great deal of confidence that you either know there's a potential issue or you might just find that you don't have a lot of issues. The larger you are, the bigger the concern needs to be. But without nexus, there's nothing from a sales and use tax perspective that you need to be worried about. So that's why we take that first step in analyzing nexus. Once we do have nexus, then we start to ask some additional layers of questions. The first of which is, what is the taxability of the products or services that I deliver into that state? And, you know, like nexus, taxability has its own set of nuances. Every state has a different way of attacking different types of industries and services from a sales tax perspective. Generally, we can rely upon the fact that all of the states that have a state-level sales tax start with the concept of sales, retail sales of tangible personal property are subject to tax. And then there's the other side of the equation, which is services. You know, I think a lot of people have historically had the impression or the opinion that services were generally not taxable, particularly what people would refer to as professional services. And that's not necessarily the case, and it does trip people up quite a bit. There are a host of services that are subject to sales or use tax. More common types would be installation services. Telecommunication services are taxable in majority of the states. So there are a lot of nuances around services. When we talk about professional services, just to touch on that briefly, there are what I call the five primary professional services, and that being medical services, accounting services, legal services, architectural and engineering services. And those services, for the most part, in almost the mass of the states, do not tax those professional services. There are a few exceptions to that rule. Hawaii, New Mexico, there's some exceptions there. The other side of the equation from a taxability perspective is situsing. Situsing is really just determining where the taxable event occurs. In other words, if I'm located in Ohio and I'm selling product to a customer in Colorado, where does the tax get imposed? Is it Ohio sales tax? Is it Colorado sales tax? And those situsing rules are dependent upon a number of factors. Usually, if it's tangible personal property, it's where title to that property is deemed to have transferred. Customarily, and the majority of transactions here in the U.S., if a transaction is delivered FOB destination, then we look to the destination address as the situs for applying the sales tax on that transaction. Versus if the shipment or transaction involves an FOB origin shipment, we're assuming the title transfers at the shipping dock at that point, and that the buyer has taken, if not possession, at least title to the property at that point and has risk of loss during transit. And in those circumstances, generally we would apply the rule that the Ohio would be the situsing for the sales taxes in that transaction. But there's a lot of strange and different rules that apply to transactions when there's interstate commerce involved. So those are just some examples. They're not necessarily the standard across all situations, particularly when it comes to services. And just to end that taxability conversation on services, generally services are situs where the benefit of use or benefit of receipt occurs. And that usually is where the customer is receiving the service, using the service, getting the value of the benefit of the service. Yeah, so we've kind of covered the basis, the foundation of sales tax. We've identified potentially where we have nexus for sales tax purposes, and we start to evolve into exploring whether or not there's a material risk or exposure within the business. And that's where you start to evaluate the taxability of the products and services, as we've just discussed. But another category of taxability is your customer base. If you're selling in some states to the state and local government primarily, that may be an exempt transaction. The state and local governments of some states, a lot of states, frankly, are not subject to sales tax. Interestingly, there are some states where the state and local government is subject to sales tax. Sales to the federal government is another example. Generally, there's no tax imposed on retail sales to the federal government or any of its agencies. Anybody operating in New Mexico, just be wary. The rules are a little different in New Mexico because their tax scheme is just a little different. So when I talk about federal government sales, it doesn't always play out that way in New Mexico. Then lastly, nonprofit organizations. These are, again, customer types, entity types, or industry types that qualify as exempt in certain states. The other more common exemption would be for resale. So major retailers are constantly buying inventory for resale. Even small retailers are buying inventory or buying product for resale. So resale exemptions are, I would say, the more common exemption that exists in sales and use taxes. So as you start to sort of peel back this onion, after you kind of establish where nexus exists, and you kind of have a good feeling as to where your products and services are taxable, now after you've kind of characterized your customer base, you then have an opportunity to start a real quantification effort by state. Now, if you're not a registered taxpayer in a state, you really don't have the advantage of a statute of limitations. And the states, frankly, can go back as far as they'd like. Most of them administratively only go back 7 to 10 years on a non-registered taxpayer. As we talk through this today, I'm going to be primarily talking about scenarios where no tax has ever been charged or collected in the business. If you have charged tax or collected tax, that's a different scenario. And if you have that scenario personally, you really need to get that mitigated quickly. Mitigation would be getting it paid to the state as soon as possible. But for purposes of this dialogue, we're just talking about exposure in the way of, I've got nexus, I should have charged tax, but I didn't. If you have been registered, even if you've been filing zero due returns over the course of time, there could be a statute of limitations operating in your favor. And those statutes are typically 36 to 48 months. Again, every state has its little nuance, so there's a few outliers that are a little bit longer than that. So that's sort of the time frames that you're going to look for. Most of the time during due diligence, I would say that companies are, particularly on the buyer side, they're looking to go back at least 5 years to try to get a true sense for what that risk is. Some will go back even further. But, you know, the thing that I would tell you is that a lot of the buyers, when they engage resources to perform due diligence, they're not trying to get very granular. They're actually not going to get as granular as what I've just described here when I say estimate your sales tax exposure. They're more inclined to look at it from just two perspectives. One is, do you have nexus? And two, is your product or service generally subject to sales tax in that state? That's usually where they stop in their diligence efforts. And as a result, those initial estimates that come back are typically a lot higher than they really should be. And there's usually opportunities to mitigate that. And I think that's where it comes back to this last bullet on this slide. Precise quantification of prior liabilities may require some additional efforts. Sometimes it can be as simple as, my customer historically has accrued a self-accrued use tax on their purchases from us. And as a result, they've already paid this tax. It's already been satisfied. That just has to be documented in some sort of signed document or affidavit. But just know that your own estimate of your exposure is likely to be more precise, more accurate, and hopefully better than what you might find during due diligence. And for that reason, I don't think you want to wait for due diligence to occur before you start thinking about it and analyzing it. You want to be prepared. I think it's of great value, even if you know there's a pending due diligence effort coming within the next 30 days. There's still a lot of, I think, benefit in doing your own analysis and starting to prepare yourself for the inevitability that there might be some exposure. Once you do that analysis, whether it be 30 days prior to another due diligence effort, or maybe you're just at this point in time saying, look, at some point in the future, this company is going to be the subject of an acquisition, and we want to be ready for that. We want to look buttoned up. And so there are opportunities to mitigate prior period exposure during sort of that self-reflection. In a lot of cases, particularly with the companies we're working with, we work with a lot of small to mid-sized companies. They're typically not flush with cash. They've got a lot of other more important things to spend money and invest in. And so when we encounter significant exposure prior periods, we're more inclined to look forward and say, let's get registered and start to voluntarily comply on a go-forward basis, recognizing that that prior period risk still exists. And it will exist for a period of time until you really run out the general statute of limitations. So you're looking at 3 to 4, maybe 5 years of living with a little bit of anxiety for those prior periods. But it still is important. Don't bury your head in the sand. If you find that you need to be registered, take action, whether that's mitigation of the prior period liability and risk, or just getting registered and complying prospectively. Take some action and start to at least address it. We do talk to clients from time to time who feel compelled to go back and register retroactively. Of course, when you do that, you're implying to the state that you have exposure retroactively. They're going to automatically ask you to file returns retroactively for all of those periods between the time you registered and current. And they're going to expect there's some tax liability associated with that. And then lastly, the opportunity exists in all the states for a voluntary disclosure. We refer to these as BDAs, voluntary disclosure agreements. All the states have some variety of a BDA. They're not all equal. They're not all as easy and straightforward. Some are easier than others. One of the primary factors of voluntary disclosure agreements is you can't have already been registered and in compliance to participate in the program, or you can't have been notified for audit or notified with an inquiry about your sales tax risk. Now, I say that's sort of the general principle that we all follow. There are exceptions to that rule. There are some states that will let you enter the voluntary disclosure program, even though you've been registered for some period of time. So there's always a little bit of an exception and maybe a little bit of negotiation in play there that can be taken advantage of. The primary benefit to doing a voluntary disclosure, and let me just outline first what that means. When you apply for voluntary disclosure, you're basically telling the state, I did at some point create nexus in the past and had an obligation to charge, collect, and remit sales taxes. I failed to do so. I would like to disclose that fact now. And in exchange, the state's going to say, okay, we will waive all the penalties associated with that tax, so long as you didn't already charge and collect it. And more commonly, they will give you what's called a limited look-back period. And what that means is that instead of you having to disclose 5 years worth of, or 6 or 7 years worth of exposure, the state's going to treat you as though you had been registered and give you the value of the general statute of limitations that every taxpayer gets that's already registered. That's typically 36 to 48 months. When I look at voluntary disclosures, to me, there's really only one benefit, and that's the limited look-back period. I see the penalty abatement as definitely a value, no doubt about that, but we tend to see some level of relief given during audits for penalties, particularly if it's a first audit and there's no negligence. Again, everything that we're talking about here is predicated on the fact that you haven't charged and collected tax. You can enter the VDA program if you have charged and collected tax and never registered. And in some cases, that might carry with it a small penalty, maybe 5 to 10%. But anytime you're in that position, you definitely want to pursue mitigation of that tax risk as soon as possible.
So I'm going to take this next piece here in terms of establishing a compliance process. And of course, the whole context of this discussion is in light of M&A activity, and we're hoping to get companies into a positive compliance process prior to going through this due diligence. So I think as we start looking at the scenario of now we have taxable sales, we've mitigated our exposure, we've decided how or where we're going to comply prospectively, we at least have to have a process for applying sales tax and remitting the sales tax and filing the various returns as well. So I'll touch very briefly on this. I think we've had full discussions and webinars on this topic alone, but we usually start to shift our discussions with clients into this, how do we charge sales tax now? And depending on the nature of the sales, a lot of our clients are operating in an e-commerce environment where some of the e-commerce solutions have some built-in capabilities to charge the applicable sales tax. Others might be operating in more of a traditional invoicing capacity and utilizing just traditional accounting systems, whether it's a NetSuite or a QuickBooks, all of which have some native capabilities of charging sales tax as well. Some of those systems, both on the e-commerce side as well as on the just general accounting side, some of those are better equipped than others to track and to manage the sales tax properly. But whenever we start looking at what is the best option here for companies, it really is, I think, a question of how complex is your invoicing process, or said differently, how complex is your sales tax environment? So someone that's operating in a couple of states, and this is a real example from earlier this week, a discussion I had, operating in a couple of states, they're selling a single offering, I believe it was a SaaS offering, but they were issuing 30 to 40 invoices a year. In that scenario, it's not all that difficult to manage that manually within a existing accounting system. Even a system that's not really well equipped to manage sales tax gracefully, we can figure out a way to get sales tax applied to 30 or 40 invoices a year pretty easily. Now contrast that with a business that's operating in every state, that's selling multiple items, that have differing taxability in every state, with differing tax rates in every jurisdiction, that are sending out hundreds or thousands of invoices a month. There's no good way to manage that effectively without some additional sales tax software. So there are some great sales tax technology solutions that plug into the accounting systems to automate the application of that sales tax either at the checkout on the e-commerce side or at the invoicing side. And I'm sure most of you are familiar with some of those options. We have clients that utilize Avalara, they utilize Thomson Reuters, CCH, Ciratax, Vertex. Those are probably cover 80 to 90% of all the tax calc installations, but those are all very good options. A lot of times what we really start to look at in terms of which one applies best in a particular situation may come down to which of those have native integration to your accounting system. That's a big factor. And also, do they have the applicable content? Meaning, do those calc engines have the applicable taxability rules for your specific type of product or service that you're selling? We see some of the calc engines that have, maybe they focus on a specific vertical industry or two, and they may not have the specific tax content and tax codes that you need. So that tax calculation piece is a big aspect of this. And then your gears kind of shift a little bit to, now that I've collected or charged the sales tax, how do I get it remitted? And so, of course, there's options there in terms of filing internally, outsourcing the work. As I mentioned, we do a lot of the outsourcing piece. This is also a scenario of probably volume for a lot of clients. If they're in one or two states, it's not all that difficult to file a couple of returns a month. But now they're in 10 states or 20 states or 30 states, or they're filing in these home rule jurisdictions in Alabama or Colorado or Louisiana. At some point, the volume becomes overwhelming, and an outsourcing type of solution makes a lot of sense for those types of businesses. And then, if you've been in this sales tax space for a while, you recognize that the states like to send out notices to you as well. So we always encourage people that, especially if they're doing this in-house, make sure you've got a process to track those notices. It could be a paper notice that gets mailed to you. It could be a notice that's posted in the e-file website of that particular state that you have to look for and respond to as well. But just making sure you've got a process to capture the notice and respond to it in a timely fashion. A lot of times they have very tight windows of time in terms of how quickly you need to respond to those notices. So hopefully at this point, you've got a good compliance process set up. I think we've got a couple of real world examples where people didn't necessarily have a great process set up and they were actually going through the due diligence process and they had some issues that I'll turn it back over to Jeff and let him talk about those scenarios.
Yeah, with the remaining time, we'll kind of talk about a couple of these stories. One of the clients that we worked with had not been compliant. We hadn't been working with them in the past. They were referred to us by their CPA, and they had undergone a due diligence effort. One of the big four accounting firms actually did the due diligence. They presented us with a component of that due diligence result, and it became pretty evident right away that the due diligence effort was not very detailed. And that was intentional. There wasn't anything wrong with the due diligence effort. It simply just did not go down into the transaction levels like we would expect it to do for purposes of precision. So in this particular case, they received a $2.2 million escrow and were told to get any of this escrow, you're going to have to go back and mitigate those liabilities. So at the first review, we're basically looking at, okay, it's $2.2 million in risk. What can we do to mitigate a portion of that risk simply by going down the path of a voluntary disclosure? Because that 2.2 might be reflective of 5 or 7 years worth of exposure. And if I do the VDAs, I can clip off 20 to 40% of that exposure right off the top. And that's ultimately cash in their pocket. The other aspect to this particular scenario was that all of the gross receipts were deemed to be taxable during due diligence. And as it turned out, in a number of the states they were operating, the service element was significant and material and wasn't taxable. And so we were able to mitigate a large portion of that exposure going through that exercise as well. But these things, they tend to have quite an impact. We have seen sales tax due diligence crash deals before. The dollars and the risk were just too much for both parties. We have seen scenarios where the sales tax due diligence probably created the biggest heartburn throughout the sale process. And usually that's a result of the fact that there is going to be an escrowed amount. And in this particular case, it would have been a $2.2 million escrow. And until that amount or until those risks were mitigated, the buyer wasn't going to release that escrow. Well, those things have timelines driven. And so if it's a 9-month release, you've got to get that mitigation executed within 9 months. And I can tell you that VDAs, a lot of times we're at the mercy of the state in terms of timing. Some of the states are really good about moving promptly through that process. Other states, it can take 6 months. Fairly easily does the time pass, particularly when you're going through the bureaucracy of getting an agreement approved, getting registration established, and then getting acceptance of the disclosure. So it's just important to understand that sales and use tax is not going to drive the train of business progress, but it can be a missing link in the track. And if you're not careful, it can get you off track pretty easily and pretty quickly. It's not brain surgery by any means. The fact that I can do it is evidence of that. But it is something that you do spend a little bit of time on. You can make a significant amount of progress. Just for the sake of time, I'm not going to go too far into detail on any of the other scenarios, but I did want to share with you that we had a client that was operating out of a single state, Virginia. They were selling and installing tangible personal property, but the installs were being performed by third-party contractors. And they didn't realize that those third-party contractors were creating nexus. They were creating a physical presence on their behalf. And that turned out to be quite a significant exposure because they thought all along, we don't have nexus in these states where we haven't an employee or we haven't inventory or an office. But in fact, those sales, and in some cases, the actual installation, were taxable, and the states easily deem them to have nexus in those states. So you just want to be knowledgeable. And to Brian's point earlier, physical presence is still a factor in nexus. The bright line test of the economic thresholds is helpful because it kind of gives us at least a materiality level that we can focus on. Sometimes figuring out physical presence can be a little challenging. The person in the sales tax department doesn't always know where the sales reps are traveling and visiting. But in this last piece, I just want to convey a couple of other scenarios in terms of mitigation options. There are opportunities to go identify where a customer is self-accrued. I spoke about that earlier. Or maybe that customer's already been audited by the state and assessed for those periods. There's a term called XYZ letters. It's a kind of an industry term, I guess, in the sales and use tax world, but most of the states are familiar with that terminology. It's nothing more than an affidavit that is signed by the purchaser of whatever taxable event took place that just simply says or serves to validate that the sales or use tax has already been satisfied for that transaction. The other thing that we've done, and I'll end on this, the other thing that we've done in some circumstances is settle on a reasonable amount. We'll take the overall due diligence effort, and typically that involves a number of states. Let's say it involves 10 states where there's risk and exposure, and the buyer doesn't want any part of that risk and exposure. However, an educated buyer will realize that there's a risk quotient that you can put against that audit liability. And you can say, what are the likelihood that I'll get audited in all 10 states? Well, that's not very likely. So you start to dwindle down the liability to a place that's palatable. And the parties can come to some agreement where they just simply reduce the sales price by a certain amount that represents or reflects adequately that level of risk, and then the buyer just moves along, gets registered, and starts complying prospectively. And they'll just keep that settlement as an accrual for purposes of satisfying any liabilities that they might face in the future. And hopefully the settlement proves to be profitable for both sides. Now, when I say that, I'm acknowledging that the state's losing. The state's not getting the money they're due. I recognize that, but sometimes in the business transactions, you've got to get through that transaction. And the sooner we can get into voluntary compliance, as I said earlier, the better. So that's just another example of that. The last thing, I told you this would be the last thing, but this is one more last thing. VDAs, I had a note here, whether an asset deal or a stock deal. Usually if it's a stock deal, the buyer is going to force the VDAs. They're going to want it to be mitigated before they take over. In asset deals, that may not be the case. There may not be as much concern. There are still some pass-through liabilities that can exist in an asset deal from a sales tax perspective, so you want to be a little careful. But I have seen, we've worked with a company where they were purchased by a larger company that was fairly sophisticated. It was an asset deal, but they forced them to still go back and do VDAs because they did not want any potential risk of a pass-through liability, and they were forced to do that.
This has been It Depends, with another episode explaining the complexities surrounding sales and use tax. We'll see you next time.